Listen carefully because what I am about to discuss has very little to do with the daily movement of gold or silver prices and everything to do with a much larger shift that may already be underway beneath the surface of the global financial system. Most investors spend their time reacting to headlines, interpreting economic reports, watching central bank announcements, and trying to predict what markets will do next week or next month. But that is not where the biggest opportunities are identified. The largest financial transitions rarely begin in plain sight. They develop gradually, hidden beneath familiar narratives, until suddenly the evidence becomes impossible to ignore. By the time the majority recognizes what is happening, the move has often already begun. If you own gold, if you own silver, or if you are considering whether precious metals deserve a place in your financial strategy, then you need to understand the significance of the environment that is forming right now. I am not talking about a routine rally. I am not talking about a temporary reaction to a single economic event. I am talking about structural forces that have been building for years and that may now be approaching a point where markets can no longer ignore them. History has shown repeatedly that major asset repricings do not occur because everyone suddenly agrees. They occur because reality changes before consensus catches up. The real question is not whether investors can see the risks. The real question is whether they are interpreting them correctly. Most people continue to view today's challenges as isolated issues. They see inflation as one problem, debt as another, slowing growth as something separate, and geopolitical instability as an unrelated concern. But financial systems do not operate in isolated compartments. Everything is connected. Debt influences policy. Policy influences currencies. Currencies influence capital flows. Capital flows influence asset valuations. When pressure begins building across multiple areas simultaneously, markets eventually respond. What concerns me is not a single indicator flashing red. It is the interaction of numerous pressures occurring at the same time. Government debt continues climbing. Fiscal deficits remain enormous. Long-term obligations continue expanding. Economic growth is becoming more difficult to generate despite increasingly aggressive spending. At the same time, inflation has proven far more persistent than many policymakers expected. This creates a difficult environment because the tools used to solve one problem often intensify another. A heavily indebted system benefits from low interest rates. Low rates make borrowing manageable and encourage economic activity, but persistent inflation creates pressure for higher rates. Higher rates increase borrowing costs. Increased borrowing costs place strain on governments, businesses, and consumers. Policymakers become trapped between competing priorities. Every decision creates consequences elsewhere. Markets understand these realities long before official statements acknowledge them. This is one reason I believe gold and silver deserve serious attention. They are often misunderstood because many people view them only through the lens of price. But precious metals have historically served another purpose. They act as signals. They reflect changes in confidence before those changes become obvious in traditional financial markets. When investors begin questioning the durability of monetary policy, the sustainability of debt expansion, or the long-term purchasing power of currencies, capital naturally starts looking for alternatives. That process rarely begins dramatically. It starts quietly. Investors adjust allocations. Institutions reconsider risk exposure. Long-term capital gradually moves toward assets perceived as resilient during periods of uncertainty. Most people never notice these shifts because they are focused entirely on short-term price action. But behavior often changes before prices reveal the full story. You need to understand that major financial transitions never begin with widespread agreement. They begin with skepticism. The majority dismisses early signals because they are conditioned by recent experience. If an asset has spent years underperforming, people assume it will continue underperforming. If policymakers have repeatedly stabilized markets in the past, people assume they will always be able to do so. If debt expansion has not yet created visible consequences, people assume it never will. This mindset becomes dangerous during turning points because the future is rarely identical to the recent past. Most investors are completely blind to what may be forming because they are waiting for a dramatic event to confirm their concerns. But structural shifts do not usually announce themselves. They emerge through subtle changes in behavior, confidence, and capital allocation. They emerge when investors begin preparing for outcomes they previously considered unlikely. They emerge when trust starts migrating from promises toward tangible assets. Look at the broader landscape. Nations are reevaluating economic relationships. Governments are increasing spending commitments. Strategic competition is intensifying across multiple regions. Supply chains are evolving. Resource security has become a priority. Financial obligations continue growing faster than underlying productivity in many parts of the world. These developments are not isolated events. They are interconnected pressures affecting the global system simultaneously. Gold has historically attracted attention during periods when confidence becomes uncertain. Silver becomes particularly interesting because it occupies a unique position between monetary demand and industrial demand. It benefits when investors seek protection, but it also benefits when industries require increasing quantities of physical material for technological development. That combination creates dynamics many investors underestimate. The reason this matters is simple. Markets do not need a full-scale crisis to produce major moves. They only need enough uncertainty to change behavior. Once behavior changes, capital flows begin shifting. Once capital flows shift, prices eventually follow. And when positioning remains relatively light, even modest reallocations can create powerful effects. This is why I believe the next major move in gold and silver may arrive faster than many expect. Not because of a single headline, not because of a short-term prediction, but because the underlying pressures supporting interest in tangible assets appear to be strengthening simultaneously. The majority remains focused on today's noise. Meanwhile, the structural story continues developing beneath the surface. And throughout financial history, it has often been those hidden developments, not the headlines, that ultimately mattered most. Now, I want you to think beyond the immediate market environment, because one of the greatest mistakes investors make is assuming that financial conditions can remain unchanged indefinitely. History does not support that belief. Every major economic era eventually reaches a point where existing assumptions begin breaking down. Sometimes the transition unfolds slowly, sometimes it accelerates unexpectedly, but in every case, the individuals who recognize structural change early gain an advantage that those focused exclusively on short-term developments rarely achieve. What we are witnessing today may be one of those moments. For more than a decade, markets operated within a framework that encouraged risk-taking. Borrowing costs remained historically low. Liquidity was abundant. Asset prices benefited from extraordinary monetary accommodation. Investors became accustomed to an environment where central authorities consistently provided support whenever instability emerged. Over time, that experience created a powerful belief that intervention could indefinitely prevent serious financial stress. But systems evolve. The conditions that once support expansion can eventually become sources of vulnerability. Debt that appears manageable during periods of low interest rates becomes more difficult to sustain when financing costs rise. Fiscal commitments that seem reasonable during periods of economic growth become far more challenging when growth slows. Policies that stimulate activity during one phase of a cycle can create unintended consequences during another. This is why I continue emphasizing the importance of understanding structure rather than focusing exclusively on predictions. Predictions create certainty where certainty does not exist. Structure reveals probabilities. When I look at the current environment, I see multiple forces converging at the same time. Government borrowing requirements remain elevated. Long-term obligations continue expanding. Demographic pressures are increasing in many economies. Productivity growth remains inconsistent. Inflationary risks have not disappeared. Geopolitical tensions continue influencing trade, investment, and resource allocation decisions. None of these developments alone guarantee a major shift. What matters is their interaction. Financial systems are remarkably resilient when facing isolated challenges. They become far less stable when multiple pressures begin reinforcing one another simultaneously. Debt affects interest rates. Interest rates affect budgets. Budgets influence policy choices. Policy choices affect currency confidence. Currency confidence influences capital flows. Every component is connected. That interconnected reality is often ignored during periods of relative stability. Most people assume tomorrow will resemble yesterday because that assumption feels comfortable. Yet nearly every significant financial transition in history occurred precisely because prevailing expectations failed to account for changing conditions. Investors became anchored to familiar narratives. They believed existing trends would continue indefinitely. They underestimated how quickly confidence could shift once underlying pressures reached a critical point. This never ends quietly. Major transitions are rarely recognized in real time. During the early stages, most observers dismissed the warning signs. Policymakers describe challenges as manageable. Analysts debate whether risks are meaningful. Investors remain focused on recent performance. Meanwhile, the underlying structure continues changing beneath the surface. Eventually, reality begins influencing behavior. Behavior influences capital flows. Capital flows influence markets. And markets begin repricing. This process is especially important when discussing gold and silver, because precious metals often respond to changes in confidence before broader financial markets fully recognize what is happening. Their role extends beyond speculation. They have historically functioned as alternative stores of value during periods when uncertainty surrounding monetary systems, debt sustainability, or purchasing power begins increasing. That does not mean every economic challenge produces an immediate surge in precious metals. Markets rarely move in straight lines. Volatility remains part of every cycle. Corrections occur, sentiment fluctuates, expectations shift, but long-term trends are frequently driven by structural forces rather than short-term headlines. This is where many investors make a critical mistake. They spend enormous amounts of time studying daily price movements while ignoring the conditions that ultimately determine long-term direction. They become obsessed with timing while neglecting preparation. They search for perfect entry points while overlooking the larger forces that may be reshaping the financial landscape. Preparation has always been more valuable than prediction. The investors who navigate major transitions successfully are not necessarily the ones who forecast exact outcomes. They are the ones who recognize changing probabilities before consensus forms. They understand that opportunities often emerge during periods of uncertainty because uncertainty discourages participation from the majority. That principle applies directly to gold and silver today. Despite growing concerns surrounding debt, inflation, fiscal sustainability, and currency purchasing power, precious metals still occupy a relatively small portion of most investment portfolios. Many investors remain underexposed. Others have ignored the sector entirely. Participation remains far below the levels typically associated with widespread enthusiasm. That matters because major moves often begin when positioning is limited. When expectations remain subdued, it takes less incremental demand to create significant effects. A relatively small shift in investor behavior can produce disproportionately large results. This becomes particularly relevant for silver because its market size is considerably smaller than many major asset classes. Even modest reallocations can have a meaningful impact when supply growth remains constrained and participation remains limited. Most people focus on what is happening today. I focus on what may happen if current trends continue, if debt keeps expanding, if inflation remains persistent, if fiscal pressures increase, if confidence in traditional financial structures weakens, and if investors continue searching for tangible stores of value, then the environment supporting precious metals could become considerably stronger than many currently expect. The real question is not whether volatility will occur. Volatility is inevitable. The real question is whether investors are paying attention to the forces creating that volatility in the first place. Because history repeatedly demonstrates that the biggest opportunities emerge before widespread agreement exists. They emerge while uncertainty remains high. They emerge while skepticism dominates public discussion. And they emerge while the majority remains convinced that nothing significant is changing. Yet significant change is often already underway. And if the structural pressures developing today continue building beneath the surface, the next major phase for gold and silver may arrive much sooner than most investors are prepared for. Now I want you to consider something that receives far less attention than it deserves. Most investors spend enormous amounts of time evaluating individual assets, individual companies, and individual market sectors. They compare valuations, analyze earnings reports, monitor economic releases, and follow every headline that appears across financial media. But very few stop to ask a more important question: what happens when the foundation supporting the entire system begins changing? That question matters because every financial asset exists within a broader monetary environment. Stocks do not operate independently of interest rates. Bonds do not operate independently of fiscal policy. Real estate does not operate independently of credit conditions. Everything ultimately connects to the larger framework through which capital moves. And when that framework begins experiencing pressure, investors must adapt. This is not a new phenomenon throughout history. Periods of significant wealth creation and wealth preservation have often occurred during moments when investors recognized major shifts before they became obvious. The individuals who waited for universal agreement usually arrived late. The individuals who paid attention to structural developments often gained the flexibility needed to respond intelligently rather than emotionally. That distinction is critical. Emotional decisions rarely produce consistent outcomes. Preparation does. Right now, one of the most important developments occurring beneath the surface is the gradual reassessment of risk. For years, many investors operated under the assumption that traditional financial assets offered the most attractive opportunities with the least concern regarding long-term stability. Economic growth appeared resilient. Monetary support remained available. Inflation seemed contained. Debt expansion appeared manageable. Today, those assumptions are being questioned, not abandoned entirely, questioned, and that process alone can have enormous implications for capital allocation. Markets are driven by confidence. Confidence influences investment decisions. Confidence influences valuations. Confidence influences the willingness of investors to accept risk. When confidence remains strong, capital naturally flows toward assets promising growth and return. When confidence becomes uncertain, priorities begin shifting. Preservation becomes more important. Diversification becomes more important. Resilience becomes more important. This is where gold and silver enter the conversation in a meaningful way. Their value is not based solely on price appreciation. Their significance comes from the role they can play during periods when investors begin reevaluating assumptions about the future. Precious metals have survived countless monetary systems, political transitions, economic disruptions, and financial cycles. Their relevance has endured because they represent tangible assets that exist outside many of the risks affecting traditional financial instruments. History has demonstrated this repeatedly. Whenever uncertainty surrounding currencies, debt obligations, or purchasing power begins increasing, interest in tangible stores of value often follows. Not immediately, not all at once, but gradually enough to establish trends that can become powerful over time. Most people underestimate how quickly sentiment can change. One day an asset is ignored, the next day investors begin discussing it. Soon after, institutions start increasing exposure. Then broader participation follows. By the time widespread enthusiasm appears, the largest portion of the move has often already occurred. This pattern has repeated throughout financial history. The reason is simple. Markets move ahead of certainty. Investors wait for confirmation. The gap between those two realities creates opportunity. That is why I believe awareness matters far more than prediction. You do not need to know exactly when a major move will occur. You do not need to know the precise catalyst. You do not need a perfect forecast. You simply need to recognize when structural conditions are becoming increasingly supportive of a particular outcome. And when I examine the current environment, I see multiple factors that deserve serious attention. Debt burdens remain elevated. Government spending commitments continue expanding. Inflation risks have not disappeared. Purchasing power remains a long-term concern. Geopolitical uncertainty continues affecting global markets. Central banks face increasingly complex policy choices. Economic growth remains uneven. These realities are not temporary headlines. They are structural considerations that may influence capital flows for years. That does not guarantee a straight-line advance for gold or silver. No market behaves that way. Corrections will occur. Volatility will occur. Unexpected developments will occur. But long-term opportunities are rarely defined by temporary fluctuations. They are defined by the larger forces operating beneath the surface. This is why I continue returning to the same conclusion. The real story is not today's price action. The real story is the environment being created by the interaction of debt, inflation, policy uncertainty, and shifting investor behavior. Those forces matter. They matter because they influence confidence. They matter because they influence capital allocation. And they matter because they influence where investors choose to seek protection when traditional assumptions become less reliable. Most people will not recognize the significance of these developments until much later. That is how major transitions usually unfold. The majority waits, the prepared minority observes. The majority seeks certainty. The prepared minority studies probability. The majority reacts. The prepared minority prepares. As we move forward, the most important question is not whether gold and silver experience short-term volatility. They will. The most important question is whether the structural pressures building beneath the financial system continue strengthening. If they do, then the next major move in precious metals may arrive far faster than most investors currently expect. And if that happens, the greatest advantage will not belong to those who predicted every detail correctly. It will belong to those who paid attention early enough to recognize that the environment was changing long before the crowd realized it.